Hi everyone, I'm Karyn Filiatrault, a Toronto realtor with Bosley Real Estate and HomesweetKaryn.com, and this is my video blog. I'm here today with Jason Lang.
Hello.
Welcome.
Thank you.
Jason's with the Lang team, one of Toronto's top mortgage advisory teams, and we're here today to talk about interest rates.
Ooh,
I know. Don't tune us out just yet. I know how interest and rate can kind of be buzzword killers, but the reality is, if you are looking for a home in the future, this is something you want to wrap your head around and get interested in, right? So anyway, first question for you, especially for our new people, what are interest rates?
Interest rates, I guess to back it up a bit, most people don't have a wad of cash to buy a home outright. So a lot of times they'll need to borrow those funds from either a bank or a lender, and what they do is they borrow that in the form of a mortgage. The interest rate is essentially the cost of that mortgage per year. So example, if you needed to borrow $100 for a year and it cost you $2 in interest, your interest rate would be about 2%.
Gotcha. And are there different types of interest rates?
Yeah, there are. The two interest rates that you'll see most commonly quoted in the media would be a 5-year fixed interest rate and a 5-year variable interest rate. Now the difference between the two is a fixed is essentially just that. You lock in a specific interest rate for the 5 years and you pay based on that amount, where a variable, it can fluctuate up and down, and the benefit of that is usually you get a lower price up front. So.
Gotcha. Why do they go up and down?
That's a
Why
novel.
can't they be down and low forever, right?
I'll try to keep it short and sweet and to the point, but essentially interest rates will tend to follow the economy.
Okay.
So, example, if you're in a contracting or slowing economy, interest rates will tend to be low or move downward. Whereas if you're entering an expanding or a growing economy, they'll tend to trend upwards.
Gotcha.
So,
now, when we look at the last 10 years, where do we sit on the high-low meter?
I'll even expand broader than that because it gives some pretty interesting perspective.
Okay.
Canada did change some monetary policy in the early 90s to help stabilize the rates, but if you were looking for a 5-year fixed mortgage back in the 1980s, your interest rate would have been somewhere between 10 to 20%, which it's pretty crazy. And then between about the 90s to 2008, that band was between about 5% to 10%. And then since then, given all of the economic instability and uncertainty, we've been well below 5%. We're actually now at the lowest point in history, kind of mid 2% range for a 5-year fixed and even lower for a variable. So crazy times.
I'm Jason. Can we get any lower?
Yeah. I don't think there is room for any significant lowering, but we might see a little bit of movement just because the different banks and lenders are competing for business. But essentially, I think we're at the bottom.
Cool. Now, the media and the buzz and everything else is that it's fall, and that's because they've been so low, they're going up. Yeah. Is that the case?
In fairness, that's been the case probably for the past 3 years because everyone says eventually they're going to go up. Eventually they're going to go up. I think now there is some weight behind that, given the U.S. economy is doing so well right now that the anticipation is interest rates in the U.S. are going to go up kind of in the fall or later this year into next, which will put a lot of pressure on Canadian rates. Personally, I don't think we'll see rates going up until early mid-2016, but again, economic forecasts are made to be broken, so please don't hold me to it.
Right. Okay, so what's a person to do? They're so low, they might go lower, they might go high. What should somebody do right now during this fall market?
No, a great tool that everyone has available to them is something called a rate hold. So if somebody talks to their mortgage advisor, what they can basically do is lock in these current low interest rates just to protect themselves if rates were to go up. I mean, worst case, you don't need it. You get the better rates if they happen to go down. But if they do go up and you have that rate hold, you could potentially save thousands, even tens of thousands of dollars. Which, that's the buzzword.
Yes, that's the buzzword for sure.
But definitely doesn't hurt to contact your mortgage advisor.
Good, awesome. You heard the man save thousands of dollars and get a rate hold right now. Yeah. Jason, thanks so much for joining me today.
Thank you.
And we'll see you all next time.
Okay.
Bye.